Hey everyone, uh, we'll take a look at the SPY chart and make some guesses about where we could go, and look at a bearish pattern on the hourly chart and talk about the moving averages and when they cross over. And first of all, let's take a look at today's action. It wasn't a surprise that we tried to move back up today, because we push way down below the trading range for this day, for this week, and I talked about that in the first video of the week. And so it was no surprise we moved up. But let's go ahead and take a look at the hourly chart here, where we can see another bearish pattern unfolding. This is a bearish pennant. We had the flagpole move down, and then we've got a sideways consolidation, and using this top of the wick and this low here, you can see that there's a bearish pattern here, and the expected move would be a continuation of the downtrend. And if we do a measured move on the pennant, which I don't usually do on the pennant, so don't take my word on this, but if this were to hold, we can expect some moves to the 201.50 area. So that would be the next leg down. Right now we're at 205.74, and so we're gonna look at about maybe $4 move, 430 move down. So this is the bearish pattern I saw on the hourly, looking at the chart today. And so what's going to happen next week? Well, if that pennant holds true, we don't have much room at the nose here, so something's going to happen early next week. The expected move is to go down, but you always have to keep an open mind. Anything can happen. The hourly time frame is not as significant as the daily time frame, which is not as significant as the weekly time frame. So we have to keep an open mind and think, what else can happen? Well, we clearly are below both the 50-day and the 10-day. The 50-day is right at the neckline, and we haven't, we tried to retest here, but we could easily go back up and retest the neckline and wait for these moving averages to start rolling over and coming down. It's not unexpected for it to move back to the neckline, and as you'll see in the next chart, we may even actually go above the neckline. But the most important thing, whether it crosses back over the neckline or not, is that we don't go as high as this high. We can easily go above the neckline, even above the 10-day, and still be making a lower high. So these lower highs is what you really want to see, because that's ultimately the definition of a downtrend. And so we can still move in this area and still be making lower highs, but most likely we'll hit against resistance at these moving averages and then head down. So what we want to see is, or what we expect to see is, if we head back up in this direction, to encounter resistance at this line, and possibly we can go sideways until the 10-day crosses over the 50-day. So that's called a bearish crossover, and I'm going to take a look at some previous charts and observe what can happen in those kind of situations. And as Mark Twain used to say, although history doesn't repeat itself, it certainly does rhyme. So if we want to learn about the future, we can look in the past to study the behaviors and previous movements. And so I found this chart that it was very similar to where we are today. So we're looking at the 2011 time frame. We had another head and shoulder pattern, and we had a break line of the neckline here. And like our pattern, we had an up day the following day, which is right here. Our candle is a little bit less, a little bit different than the other candle. It's more weakness here because we closed well below the midpoint here, whereas in the past candle, this one was closing in the upper range of the day. So it got a nice bounce up, and it went up above the neckline, even crossed over the 10-day line and closed above it. But it made a lower high. We didn't know it at that time, but the following day you certainly knew it when we broke above the 10-day and closed again. Now that's a bearish signal where we can't hold above the 10-day. We went back below the 10-day. We broke the low of this candle, and this type of candle, hanging man or reversal, bullish reversal candle, depending on where it's located, at the top of a chart or the bottom of a chart, this could be bearish, or down here is bullish. In this case it was bearish, and then we rolled over, made a lower low, and then actually went all the way back up. And if you look carefully here, let's see, the high of this day was 134.92, and the high of this day was 135.03, just pennies apart, but yet it is a lower high. Very important. Lower highs, lower lows, higher highs, higher lows. Keep those phrases in your mind. That's really what you want to see. So we can have this kind of sideways action until the 10-day crosses over here with the 50-day, and boom, we get a huge red candle, and then the 10-day then serves as a strong resistance and a pullback along the 10-day. And you can see here that after the crossover, we finish our last leg down to the measured move here. So the 10-day crossing over the 50-day is a bearish event. Again, here we had a double top pattern, which is a bearish event. We had downwards movement sideways until the 10-day crossed over the 50-day and pushed the price down here. This was not a big move, but it was the final move, waiting for the 10-day to cross over. And then go ahead and take a look at this particular one here. We had the 10-day crossing over the 50-day. Price broke the 50-day here, and we went sideways and even further down, but rallied back up. When a crossover happened, it went down, went back up to the 50-day, was rejected, and went below the 10-day and the 50-day, and then we finally made the big move downwards. And all this time along here, we had a lower high. So you see this candle here, it looks like perhaps we have a bullish engulfing here. And candlesticks, unfortunately, are not as reliable always on their own, and it really depends on their location. But it was reasonable to expect perhaps that a bounce off of this support line here from this candle and this candle, this bullish candle, you may at the moment when you couldn't see the rest of this chart, you may have thought that was the bottom, and that was a reasonable expectation. We even closed above the 10-day, but what we didn't do was make a higher high. So here we had the high, here was the previous high, here was the previous high, here's the previous high. So let's say it together: lower highs. Lower highs are not bullish. Okay, now if we had another day here where we closed above that, then we can start changing our sentiment. But clearly the follow through did not happen. We have more railroad tracks action here, and more downside here. So lower highs is very important. Let's see here, what's the next plan? Again, here we had a break of the crossover of the 10-day and the 50-day here, and that's when price made its final leg down. Again here, the same thing, it was downtrend, waited for the crossover, and then made a final leg down. Again here, crossover, it was bearish, went sideways until the crossover, and then the 10 days pushes the price down for the final leg down. So that's what we could be, even though we may look like we're going up, as long as we're not making newer highs, at least on the daily time frame, we can expect it to go up, retest the neckline, and watch how the moving averages behave. Once the 10 crosses over the 50, expect a bigger move down in the near term. So that's it. If you liked the video, if you found it educational, please click on the like button. And if you want to stay in touch, click on the subscribe button and get informed when I put out new videos. So thank you so much for watching.